revenue recognition concept. Now, this concept has two parts to it. First one being revenue. We all know what is revenue. Revenue is sales generated on various transactions. Now, the second part is recognition. Now students, what is recognition? That is, at what point of time should we recognize that sales have taken place? Now, in relation to sales, there are various steps. We will receive an order. We will execute the order. Or we can say that there would be an agreement. Then there would be delivery of goods. So these are basic steps. We will receive an order, we will execute the order, or we will enter into an agreement regarding the sale of goods, and lastly, we will deliver those goods to the party who had ordered them. So at what stage should this revenue be recognized? So this principle clearly states that the revenue should be recognized at the time of entering into an agreement, not at the time of receiving the order and not at the time of delivery of goods. Delivery might take place a few months or a few weeks later than the agreement. The order might be a few weeks preceding this agreement. But as per this concept, the revenue must be recognized on the date the agreement to sell goods is actually entered into. Matching concept. As per this concept, the correct figure of profits of a business can be calculated only if the expenses that are incurred in an accounting period are matched out of, or I should say are subtracted out of, the revenues earned during the same period. That is, revenues in an accounting period minus expenses in accounting period. That is same accounting period. When the expenses are deducted from revenues, only then the correct figure of profits is arrived at. Mind it, there is no distinction between the expenses whether they have been paid in cash or not paid in cash. Any kind of expense, if it has been incurred during a particular accounting period, should be deducted out of the revenues of the same accounting period, whether realized in cash or not. Only then we will get the correct figure of profits of a business. Accounting conveys a lot of information to the parties which are interested in accounts. Now, various parties, as we had done earlier, they include banks, they include owner, they include management. Each of these parties has a specific requirement which they look for in accounts. So the full disclosure concept states that all material that is important and relevant, all material and relevant information should be disclosed through accounts. Okay students, now that is, all the material and relevant information should be disclosed. It clearly means that the business should no way try to hide material facts which are important for the users of accounting information. Now, full disclosure involves various other legal aspects also. There are various legal bodies in various countries which have stepped in to ensure that this concept is rigidly and religiously followed. In India, we have SEBI, that is Securities and Exchange Board of India. Then Companies Act 1956. These are legislations, or the SEBI has ensured certain guidelines which ensure that various organizations, various companies are preparing their accounts in a particular manner which end up disclosing the complete and detailed information about the aspects and the various transactions and the various events in the business.